Okay, good afternoon everyone. I'm Jacques Conradie, and it's my great pleasure to welcome you to our investor evening following 2022, where we're going to delve into 2022's performance and give you a look ahead at 2023. I was thinking this afternoon when I showed up at the venue that this is so foreign for us as hedge fund managers to talk to a big group of people. And when I joined in 2007 and when Dave started the business in 98, some of our long-standing investors will know the only thing you ever got from us was a number at the end of the month. So that's the return. And I don't think we actually wrote any commentary, quarterly, annual, nothing for the first 20 years. And then 2018 started with that. So I think things have moved quickly from then, and it's fantastic having so many faces here, long-standing investors, new faces, welcome. If I look at 2022's return, I think it's pleasing to have delivered double-digit returns, especially given how tough the global environment was, with many developed market indices ending the year down close to 20%. I mean, our real commitment is to deliver consistent risk-adjusted returns to investors. That's really what we want to do, and that's what we want to deliver year in and year out. Our program for the day is that I'm going to do a short presentation covering last year's returns and our current positioning, and then we're going to get a panel discussion going with a few of our portfolio managers. We will deal with some of the questions some of you have sent us, and we're also going to open it up to the audience where you can participate and tell us what the pressing issues are. All right, so 2023 is a very special year for us as a business. Peregrine Capital was founded in 1998, so it's our 25th year running a hedge fund. We're the oldest hedge fund managers in the country. And our mission since day one has been to create wealth for our clients through consistent, strong risk-adjusted returns. I think it's been very pleasing that for the first 25 years we've been able to do that. But one of our company values, one of our key values is that it's always day one at Peregrine Capital. So you can rest assured that we're not looking back at the last 25 years. We're saying, how can we make sure the next 25 years are as consistent and as good for investors as the last 25? It's going to be about performance. You'll see our theme here is 25 years of performance. That has always been the North Star of our business, and it's very important to me personally that performance stays the number one thing and really the only thing that matters in our business. We can do many other things right, but if we don't get performance right, nothing else matters. So that's always going to be the driving force in Peregrine Capital. So let's quickly just look at a few introductory points for those that might know us less well. We're a boutique fund manager that's been around for about 24 years now. We manage over 15 billion rand of investor money, and we've had a consistent investment process all the way through since inception. I think one of the things that make us special is the industry-leading alignment of interest, where all the staff and the key portfolio managers have the majority of their net worth invested in the funds right next to you as investors. And I think that creates a different vibe and environment in the office where we're managing our own money right next to that of our investors. On the top right hand of the slide, I just listed two achievements that I'm personally most proud of that we've achieved as a business. And it's being the first ever fund manager in SA to generate 100 times money for investors since inception, which the High Growth Fund has done. And then I think equally as pleasing as our pure hedge fund that's done about 75 times money now, so million rand day one to 75 million right now. And it's done that without ever having a negative year, which I think might be a true standout even on the global hedge fund scale. And I guess it's a key goal for us to also get that fund to 100x. So I think the important thing for me when looking at a fund manager, which all of you do is selecting where to invest your money, is you've got to realize that the investment returns are nice to look at, but they are really an outcome of a process, of how the business is run, of how things function there, and how things get done. So if I try to break that down into three really key concepts, I think there's many things that go into good returns, but let's break it down into three key classes. Firstly, it's having the right client set. Having clients like yourselves with a long-term investment time horizon. Because that, at the end of the day, allows us, when we look for ideas and when we look for investment opportunities, to not try to manage the fund to get the best monthly or quarterly return. Because that means you leave returns on the table that you could have made over the longer run. So having the right investor base allows us to think long term and delivers better outcomes. Then it is a people business at the end of the day. So having the right people is absolutely vital, but also having the right culture, having the right type of person, hardworking, smart, and then having the right values to align us as a team and generate returns. And then finally, naturally, the investment philosophy that underpins how we construct the portfolio, how we pick stocks. And I'll quickly go into each of those as we go through the presentation and give you just a few more insights into how we think about them. So let's look at the outcome now before we look at the inputs into the investment return. I'm happy with how last year went, and I think, first year, just the blue bar is high growth, and then yellow is the multi-asset high equity balance fund category, and then grey bar is the market. And I think this is naturally exactly how we would like the picture to look, what we aim for, to have consistent outperformance versus the peers versus the overall market on a consistent basis over all time periods. And it's also vital that that has not been generated by taking higher level of risks. In fact, versus the market, we take substantially less risk, and we do even take less risk than the average balance fund if you look at our volatility over time. So it might not always look quite as attractive on this over all time periods, but that's certainly what we strive for and we're going to work hard to try to achieve. For peer hedge, the picture is very similar, and I think the returns there is surprisingly consistent. 1, 3, 5, 10, and 15, all in this kind of 10 to 15% range, which is what we target for that fund. And again, nicely above both inflation and the multi-asset low equity or stable fund category. And I think particularly last year, when inflation was high and markets were weak, it's great to have still delivered inflation-beating returns in that year. So now on to those three key elements, our clients as our partners. Our purpose is to create wealth for our clients over the long run by partnering with them. As I touched on earlier, we like clients that think long term, as a lot of our decisions are made with a 2 or 3 year time horizon. When we model out companies and investment opportunities, that is the typical window we look at, 2 or 3 years. Naturally, there's some that might be longer, there's some that might be shorter, but a lot of our core holdings have that kind of time frame. So you want clients that's willing to partner with you for that duration. Naturally, we're also going to do our best to manage short-term volatility, but the primary hat you have to have on is long-term. As I touched on earlier as well, I think being invested next to your clients is a key differentiator from many long-only managers where you've got staff that kind of do this as a job. I think it's very different for us. It's our passion, it's our life. This is what we care for. This is what we read about sitting at the beach on the holiday. It's what we love, and I think you want people like that managing your money. If I just go on to one or two cultural elements, we've got a set of 11 values, and I thought I'll just bring out 2 here to give you a sense of how they apply to specific market environments. This is a core value for us, that we want to keep learning and improving. You'd think a business that's been around for 25 years, we might have learned all the lessons there is to learn, and fortunately and unfortunately, that is absolutely not the case with markets. You are going to keep learning lessons as long as you play this game. That's part of what I love, is that you will never know it all in markets. You'll keep getting 2 or 3 out of 10 calls wrong. That's practically how this works. You're dealing with the future, but you can always get a little bit better every year. Take the lessons, look back, and learn. And one thing I told the team is it's easy after a poor year or after a year of underperformance. There's often easy mistakes to learn from. But I think one of the things we found looking at our own business and looking at other fund managers is that your mistakes don't come after bad periods, because then you're hungry and then you're trying to fix things. Your mistakes often comes after having good years like we had last year. So we want to make sure that we remain extra vigilant, and even in times when overall we're making good decisions, still try to find the key lessons where we can learn and improve. I think David always says that since the start of our business, we've always guarded against complacency and arrogance, and I think that remains as true today as it did back then. We got to stay hungry, and we've got to keep learning and improving to stay ahead of the market. Maybe one further value to touch on is speed. And again, it's something that I think is quite different in a small business, a boutique asset manager like ourselves, versus in a larger business. My feeling is that at the rate markets move these days, you simply don't have time to get a company results or see management, take 2 or 3 days to send out a research note, then take a week or two and wait for the investment committee to meet and then decide what to do with that share. Things move faster than that. You have to realize instantly what happened, make a quick decision in the office and be willing to act, especially when there's key new information. And I think our business has always been set up like this. We're all in an open plan office, we share information immediately, and that's one of the key things we've maintained throughout our history, is that ability to be small, move fast, and rapidly make decisions. Right, let's move on to investment philosophy. Again, I think you've got to do many things consistently right to deliver outperformance over time. If it was only 1 or 2 things, then everyone would do it, and then all track records would be similar in the markets. Unfortunately, it's not, and I think you've got to do many things consistently right. But if we touch on a few of the really important ones here, I think the two on both sides kind of go together here. We're not benchmark-focused investors. We never have to match an index. We never have to own a share because that share makes up 5 or 10% of the JSE. And that allows us to not take positions in companies that's not good ideas. So it allows the point there on your left to say, we only invest in our best ideas. There's many companies where the share might just be in a range around fair value, and we don't have to have a view, and we don't have to have it in our portfolio. We've got the luxury to find where we have an edge and take the positions there. We only invest in businesses we understand. In fact, on our largest holdings, and I think 2 of our big ones last year, big winners being Tungela and OUTsurance, I don't know if there's anyone in SA that's done more work on these companies, that's spent more time with management, and that's done deeper digging into the financials, into the sector, into competitors, into suppliers. We want to know our companies exceptionally well, and that's where we can have an edge. And then the third point is that you only invest where valuations are attractive. It's key to not only look for companies that's great businesses or that's fast-growing businesses. It only works if it's both a fast-growing business or both an attractive business model, but also the shares trading at an attractive price. And that was where it was easy to make mistakes a few years ago, and it's probably again where we relearned a few lessons. And then the fourth one here is something that's close to my heart personally. It's something I love, and that's analyzing really complicated situations. That's hard to figure out. That's an intellectual challenge. We've got to do a ton of work and a ton of reading, and those are really our bread and butter situations, and we actually thrive and pull those close when we can find them. So let's now move it to the interesting bits and just how we've constructed the portfolio right now after 2022. So this is our breakdown as at the end of 31 December, and the blue bar is high growth and the yellow bar is pure hedge. So if we start with property, you'll see we've got about a 6 or 7% property exposure. Many of the long-standing investors will know we've had years where we generated fantastic returns in the property sector, and we then largely avoided that sector after COVID because I think it was a particularly tough time for property, and we've more recently just found some nice specific opportunities that we think scope to generate good alpha for investors. The pref shares and bonds I would look at somewhat together, and this is probably the highest weighting, especially in bonds, we've had for many, many years, if not ever, especially in pure hedge. The way we see bonds in our fund is we don't have to have any bonds if the opportunities are not attractive. So if there's nothing to do, we just don't have any bonds, we park the money in cash. We're not index focused, we're not benchmark focused, but when there are good risk-adjusted returns, and often it's equity-like returns, but at bond-like risk in the bond market, we will take advantage of that aggressively. So we have significantly ramped up bond exposure, and a fund like Pure Hedge, we often have more cash balances, so there we've also got a lot of SA government bonds right now, where we think those we're going to do better than cash, and it's worked out nicely, and we've also ramped up the high-yield corporate bond exposure in both high growth and Pure Hedge, leading to the higher bond exposure. And then if I go to the equity side, you'll see about 55% net equities in high growth and about 15% in pure hedge. And specifically growth, we are running at the lower end of our historic equity exposure ranges, and we've actually continued to sell in the month of Jan as markets have rallied. our view right now, and I guess I think there'll be more time to cover this in the panel, is that there's several reasons we think still to be cautious. So you want to have some market exposure, but we are very happy to convert some of that into cash, given that cash is yielding you fairly attractive levels right now, and also given the economic risks that we see. If we then go into our net equity exposure, you'll see that let's look at high growth and pure hedge. They're both fairly similar in that roughly half of our exposure is in South Africa right now, and the other half is international, so we're fairly evenly balanced. I'd maybe just point out one thing here is, when we invest in a company like British American Tobacco or Glencore that's listed on the JSE, but it's an international business, we would classify that as an international position. I think some of the local long onlys and others put that as a South African share because it's listed on the JSE, but we feel that you should look at where the economics of the company comes from. So that's why you might see our offshore holding mix being slightly higher than some. So a lot more of this is actually listed on the JSE. We just classify it by economic exposure. And I think you should read from that the opportunities we see are balanced. South Africa, the opportunities are probably more company-specific rather than just betting on a very strong economy. We are finding nice, specific, mispriced opportunities that should deliver return regardless of the overall market. And then internationally, a nice mix of US, a little bit of China, but mostly other international in that red bucket. If I look at the reason we're still cautious, I think this is probably the main picture that covers that. We've had the most aggressive Federal Reserve rate hikes we've seen for many, many years. I mean, if you compare to the rate hike cycle of the early 2000s that effectively eventually popped the US subprime mortgage bubble, it was a similar magnitude, about 4% of rate hikes, but you had that over 3-4 years. This time we had 4.25% with some more to come over just 9 months. Now, all of us know monetary policy operates with a lag, and it's typically 6 to 12 months. So the first part of this year is exactly the period where we're going to have to see how much these rate hikes have impacted the overall economy, and also whether it's been enough to really slow down the economy in order to manage this inflation that's popping up its head globally. We just think it's hard to make that call right now, which is why we're comfortable running bigger cash balances and then watching the data to see, is inflation going to get under control, which will allow rates to stop going up, or is inflation going to stay sticky, which means you've got to push harder on rates, keep it high for longer, and eventually cause a recession. So this is the main reason we have for being somewhat cautious right now. So maybe just quickly on positioning. As I said, we're running larger cash balances to give us the ability to move quickly when we find new opportunities. And I think when cash is yielding you 8% in SA, kind of 4.5% in dollars, it's not a bad place to park money while you wait for opportunities. We've quite meaningfully upped our put option protection in the fund in the last month or two. I think most of last year volatility was just too high to make it practical to buy put options. In those times, we'd rather manage risk in the fund in other ways. But now that volatility is down again, our view is we're happy to spend a bit of premium and spend a bit of return to protect the downside. So we've got, let's say, high growth, 55% net exposure, but about 20% of put option protection to kick in if markets fall by more than 10%. So we think the downside's quite well protected in the fund, and I think we are fairly ready for continued volatility in markets. So in investments, you don't just have return, you also have risk. And I think a key driver to our process is trying to look for alpha and return sources where others aren't looking, and to effectively generate an outcome where we generate strong, consistent returns, but we don't just do that by doing the same as everyone else, because that effectively causes you to just be correlating with the market, and then investors are just taking the same view as they are everywhere else. So on this graph, we've got the 5 largest collective investment schemes or unit trust in SA, and we've measured their correlation with the overall JSE. And you'll see the typical correlation is around 80%. I think pleasingly over the last year, then if you look at high growth and pure hedge, high growth was less than 20% correlated with the market, and pure hedge was actually negatively correlated with the market. And I think this proves that there's something different about how we construct portfolios, and that our return typically comes from different sources than most other investors. And I think because of this low correlation, you'll see a much bigger impact on your overall portfolio if you add one of our hedge funds to it versus just adding another long-only fund. So this effectively is the outcome of having that low correlation. What we've done here is said, let's take a typical long-term 60-40 equity bond portfolio. Let's see how it looks over the last 10 years, and then let's add 20 or 40% of hedge funds to it. You'll see it's been a tough 10 years. The 60-40 has done 6% in overall return, with quite a big 20% max drawdown, and then about a 10% vol. And I'm just going to cover the 20% hedge scenario here, and you'll see the massive difference even a small allocation to hedge funds make. You get 3% higher annualized return, but at the same time, you drop your drawdown from 20 to 15%, and you drop your vol by almost 20%. And personally, when we manage the funds, when I manage my own money, that is really the holy grail of investing. Can you find opportunities that's going to increase the expected return while at the same time reducing your overall risk? That's exactly what we look for in the fund as well. Can we find individual stock picking ideas that's going to generate returns for our investors, but not just be correlated with the rest of our portfolio or the rest of the market? Right, so this is just high growth again. I think most of you know this picture. I mean, the only thing I'll kind of touch on here is the fact that it's pleasing to have done the 100, or I think we're about 125x now, without any meaningful drawdowns. I think it is important to manage the downside for investors, because if we look at especially retail investors' return, which is a lot of your clients here, one of the key things is really making sure that people stay invested even during drawdowns. That's where you make the big mistakes. If you cut your exposure at the bottom of the market in COVID, or even last year during a tough point, you're going to give up a lot of the upside. So having a fund where we manage the drawdown sufficiently to allow investors to stay invested during those tough times, I think is part of what we want to bring. All right, so on this one, what we've just done is compared high growth again against the balanced fund category over various time periods, and as we touched on earlier, we outperformed over all time periods. And I guess the nice thing for me is that over 10 years, if you take the very best fund out of the 207 balanced funds in SA, that's 10.5%. And high growth has beaten even the best one by 5% per annum. So not just outperforming the median or the average of the category, but even the best performer in the whole category. If we look again at risk, I think this is a picture that very nicely covers what we want to achieve. What's the toughest time for any investor in the markets? It's the times when markets are down. So on this graph, we've done the entire history of the high growth fund and looked at every down month on the JSE. It was actually somewhat surprising to me that the average down month is quite meaningful. It's an average of 3.3% if you average out all the down months. And true to that point of having the low correlation, if you average out high growth over this time, you actually get an average positive return in the negative months of the JSE, showing you that low correlation kicks in just when investors need it most. All right, so as my final slide here, I think one of the key things about markets is we don't think we're smart enough to forecast exactly what's going to happen in every year. We're dealing with a future year. There's independent variables that can change things massively. For example, last year, literally one person, Vladimir Putin, and what was going on in his head changed the outcome of markets for the entire year. That's simply not predictable. So I can't stand here and ever predict that I know exactly what's going to happen in 2023. The only thing I can tell you is that we've set up our business in a way where, hopefully in a repeatable fashion, we can say this and that and X and Y happen in the world. This is how we think it impacts global economies. That's how we think it'll impact markets, South Africa versus global markets, different sectors. Have a team of people that'll sit there together and analyze that situation and figure out how we need to react in the portfolio to protect your capital, while at the same time continuing to find opportunities that we think will add value for you through the cycle. that's what we try to do every day. I think it's in my personal opinion, it's the best job in the world, getting to look at all these things and figuring them out. And we're very keen to keep doing this, and hopefully we'll keep getting it slightly more right than wrong in the future. So thank you very much. That's it for me. I'm going to ask Alan Yates to come up. Alan's our head of distribution, and he's going to chair the panel where we're going to take some questions. Thank you.